What if I told you that the difference between the traders who consistently grow their accounts and the traders who spend years struggling is not a secret indicator, a special strategy or insider information, but one simple rule hiding in plain sight? Right now, somewhere in America, thousands of traders are staring at their screens, searching for the next big prediction. They are trying to guess the top. They are trying to catch the bottom. They are risking their hard-earned money on what they think the market will do next. And every day, many of them make the same costly mistake over and over again. But what if the market has been giving them the answer all along? What if one of the most powerful tools in trading has been sitting right in front of them, ignored by nearly everyone chasing shortcuts and quick profits? The truth is that the market does not reward wishful thinking. It does not reward hope. It does not reward opinions. The market rewards discipline, patience, and the ability to recognize what is actually happening instead of what you want to happen. In the next few minutes, you are going to discover the moving average rule that 99% of traders overlook. More importantly, you will learn why this simple principle has the power to change the way you look at the market forever. If you have ever felt frustrated by losses, confused by market movements, or wondered why success seems to come easier to others, stay with me until the end, because this message could become one of the most valuable lessons in your entire trading journey. The principle that the trend pays more than prediction is one of the most important lessons a trader can learn. Most beginners enter the market believing that success comes from accurately forecasting every top and bottom. They spend endless hours searching for signals that will allow them to buy at the exact lowest price and sell at the exact highest price. While this idea sounds attractive, the reality is that markets are influenced by countless factors, making precise predictions extremely difficult. The traders who consistently succeed understand that their goal is not to predict every move, but to identify the direction in which the market is already moving and position themselves accordingly. A moving average helps reveal that direction by smoothing out short-term fluctuations and highlighting the underlying trend. When a market is trending upward, there is often more opportunity in joining that trend than in trying to guess when it will reverse. Likewise, during a downtrend, fighting the market by repeatedly buying can lead to unnecessary losses. Professional traders focus on probabilities rather than certainty. They recognize that a strong trend represents collective market behavior, institutional participation, and momentum that can continue far longer than most people expect. Instead of asking, "Where will the market turn?" they ask, "What is the market doing right now?" This shift in thinking reduces emotional decision-making and encourages disciplined execution. By learning to follow established trends rather than constantly searching for turning points, traders place themselves on the side of momentum, where opportunities are often more abundant and risk can be managed more effectively through patience, observation, and strategic positioning within prevailing market conditions and price behavior. The principle that price above the moving average signals strength is based on the idea that market trends reflect the collective actions of thousands or even millions of participants. A moving average smooths out daily price fluctuations and provides a clearer picture of the market's overall direction. When the price consistently remains above a significant moving average, such as the 50-day or 200-day moving average, it often indicates that buyers are willing to pay higher prices over time. This behavior suggests confidence, momentum, and sustained demand. Instead of focusing on short-term noise, successful traders use this relationship as evidence that the market may still have strength behind its movement. Many inexperienced traders make the mistake of assuming that a stock, index, or asset is too expensive simply because it has already risen. However, strong markets often continue rising far longer than expected because institutional investors, hedge funds, and large market participants continue accumulating positions. The moving average can help reveal this hidden strength by acting as a visual guide to the dominant trend. When price repeatedly stays above the moving average after pullbacks, it demonstrates that buyers are stepping in and supporting the market. This creates a pattern of higher prices and reinforces bullish momentum. Traders who recognize this relationship learn to respect strength instead of fighting it. Rather than searching for reasons to predict an immediate reversal, they observe how the market behaves around the moving average and use that information to align their decisions with the prevailing direction, increasing their ability to identify favorable trading conditions while maintaining a disciplined approach to trend analysis and market participation. The principle that patience beats constant trading is one of the most overlooked truths in the financial markets. Many traders believe that success comes from being active all the time, entering and exiting positions throughout the day in search of every possible opportunity. This mindset often leads to overtrading, emotional decisions, and unnecessary losses. The market does not reward activity, it rewards discipline. A moving average can serve as a valuable tool because it encourages traders to wait for confirmation instead of reacting to every price fluctuation. Rather than rushing into trades based on fear of missing out, patient traders observe how price behaves around key moving averages and wait for conditions that align with their strategy. This approach helps filter out market noise and reduces the likelihood of entering low probability setups. Many losses occur not because a strategy is flawed, but because traders act too soon. They anticipate moves instead of allowing the market to reveal its direction. Patience allows traders to see whether price can maintain strength above a moving average or recover after a temporary pullback. It creates space for better decision-making and reduces the influence of emotions such as greed, excitement, and anxiety. Professional traders understand that preserving capital is just as important as growing it. They know that not every moment requires action and that waiting for favorable conditions can be a competitive advantage. By focusing on quality opportunities rather than quantity, traders improve their ability to manage risk, maintain consistency, and align themselves with stronger market trends while avoiding the costly mistakes that often result from impulsive behavior and excessive market participation. The principle that moving averages act as dynamic support and resistance helps traders understand how trends often maintain their direction over time. Traditional support and resistance levels are usually drawn as fixed horizontal lines based on previous highs and lows. Moving averages, however, are constantly changing as new price data enters the market, which is why they are considered dynamic. During a strong uptrend, price often pulls back toward a major moving average before finding renewed buying interest and continuing higher. In a downtrend, price may rally toward a moving average only to encounter selling pressure and resume moving lower. This behavior occurs because many traders, institutions, and algorithmic systems monitor the same moving averages and use them as reference points for decision-making. As a result, these areas can become self-reinforcing zones where market participants take action. Instead of viewing every pullback as a sign that a trend is ending, experienced traders often watch how price reacts around important moving averages. A strong bounce from a moving average can indicate that buyers remain in control, while repeated rejection near a moving average during a downtrend can suggest ongoing weakness. This perspective helps traders avoid emotional reactions to short-term market fluctuations and encourages them to focus on the broader trend. Moving averages also provide a structured way to evaluate risk and identify potential entry opportunities. By observing how price behaves around these dynamic levels, traders gain valuable insight into market sentiment, momentum, and the balance between buyers and sellers, allowing them to make more informed decisions while staying aligned with prevailing market conditions and underlying trend strength. The principle that the cross is not the secret the trend is addresses one of the most common misconceptions among traders who use moving averages. Many beginners become obsessed with moving average crossovers, believing that every time one moving average crosses above or below another, a major trading opportunity has appeared. While crossovers can provide useful information, they are not the true source of trading success. The real value lies in understanding the strength, direction, and quality of the overall trend. A crossover is simply a signal that reflects what has already happened in price. If traders focus only on the crossing itself without analyzing the broader market environment, they may enter trades during weak, choppy, or directionless conditions. This often leads to frustration because not all crossovers result in sustained moves. Successful traders look beyond the signal and study the context surrounding it. They examine whether the market is making higher highs and higher lows, whether price is consistently staying above key moving averages, and whether momentum supports the trend. Strong trends tend to create multiple opportunities, while isolated crossover signals can produce false expectations. Professional traders understand that trends are driven by larger market forces, including institutional buying and selling activity, investor sentiment, and sustained momentum. Their focus is not on finding a magical signal, but on identifying environments where probabilities favor continued movement in one direction. By prioritizing trend quality over crossover excitement, traders develop greater patience, improve their decision-making process, and avoid becoming distracted by signals that lack meaningful support from broader market behavior, price structure, and underlying momentum conditions. The principle that emotions destroy more accounts than bad strategies highlights a reality that many traders discover only after experiencing repeated losses. Most trading failures are not caused by a lack of knowledge or the absence of effective tools. Instead, they occur because emotions interfere with decision-making. Fear, greed, impatience, overconfidence, and frustration can cause traders to ignore clear market signals and abandon their plans at critical moments. Moving averages often provide objective guidance about the direction and strength of a trend, yet many traders disregard them when emotions take control. For example, fear may cause someone to exit a strong trade too early, even when price remains above a key moving average. Greed may tempt another trader to hold a position too long after warning signs appear. Overconfidence can lead traders to believe they know more than the market and encourage them to trade against an established trend. These emotional reactions often result in inconsistent decisions that damage long-term performance. The market itself is largely a reflection of human behavior, and successful trading requires learning how to manage personal reactions to uncertainty. Moving averages help create structure by providing a clear framework for evaluating trends and making decisions based on evidence rather than feelings. Traders who rely on discipline are more likely to follow their rules, manage risk effectively, and remain patient during periods of volatility. Over time, the ability to control emotions becomes a significant competitive advantage because it allows traders to stay aligned with market realities instead of reacting impulsively to every price movement, headline, opinion, or temporary fluctuation that appears during the course of a trading session. As we come to the end of this message, remember one powerful truth. Success in trading is not reserved for the smartest person in the room. It belongs to the person who can remain disciplined when others become emotional, patient when others become impatient, and focused when others become distracted. The moving average is more than just a line on a chart. It is a reminder that the market rewards those who follow reality instead of chasing predictions. Every great trader eventually learns that consistency beats excitement, discipline beats impulse, and patience beats desperation. The next time you sit in front of your trading screen, resist the urge to predict every move. Instead, focus on understanding the trend, managing your risk, and trusting the process. Small disciplined decisions, repeated day after day, can lead to extraordinary results over time. The market may test your confidence, challenge your patience, and expose your weaknesses, but every challenge is also an opportunity to grow stronger, wiser, and more resilient. Keep learning. Keep believing in your ability to master both the market and yourself. Your future success will not be determined by one trade, 1 week, or one setback. It will be determined by your commitment to continuous growth and disciplined action. I wish you good luck, profitable opportunities, and the courage to stay focused on your goals. Thank you for spending your valuable time with me today. If you found this message helpful and inspiring, please follow, support, and subscribe to Mind Wealth Theory for more powerful insights on trading, wealth building, success, and personal growth. Until next time, stay disciplined, stay patient, and keep moving toward the future you deserve.